What if the very dream that built America is now quietly bankrupting it? For generations, education was sold as the ultimate ticket, the ladder to the middle class, the proof of ambition, the key to a better life. But behind every diploma now sits a shadow, one measured not in grades but in dollars. Today, 45 million Americans owe over $1.7 trillion in student debt. That's more than all the nation's credit card debt combined, more than auto loans. It's a debt crisis born not from reckless spending but from hope itself. And the question we must ask is, when did higher education stop being a dream and start becoming a trap? This is the story of how America built an education empire on borrowed money and how that system grew into one of the largest financial bubbles in history. To understand the student debt crisis, we have to go back to a time when college wasn't for everyone. In the 1940s and 50s, less than 10% of Americans held a college degree. Most people went straight to work after high school. Then came World War II, and with it the GI Bill. For the first time, millions of returning soldiers were offered free or low-cost higher education. Universities expanded, campuses grew, and the idea of college as a path to opportunity took root. And began in the 1960s when President Lyndon Johnson was the most powerful weapon against inequality. And so in 1965, the higher education was born, creating the foundation for the federal student loan program. The logic was simple. If more Americans could borrow to pay for school, more could earn degrees, and the nation would prosper. But few realized that same logic would plant the seeds of an economic time bomb. The 1970s brought both opportunity and inflation. College enrollment surged, but so did tuition. The government stepped in, guaranteeing loans that private banks issued to students. This removed almost all risk for the lenders. If a student couldn't pay, taxpayers would for universities. This was a gold mine with guaranteed loans flowing in. Colleges could raise tuition year after year, and students armed with federal aid would still pay. By the 1980s, college had become a business and students the customers. The Reagan era accelerated the trend. Federal grants money students didn't have to pay back were cut dramatically. Loans took their place. By 1990, student borrowing had tripled and average tuition costs had doubled. Still, families paid because the message was clear. A college degree is your only way to succeed. In a country built on competition, that belief became gospel. Then came the 1990s, a boom decade. The internet was rising and the economy was strong, and everyone wanted a slice of the new economy. Tech companies, finance, consulting all demanded degrees. Parents told their kids, go to college no matter the cost, and Wall Street listened. In the early 2000s, private lenders and banks discovered that student loans were more profitable than they'd ever imagined. They began bundling student loans into securities, selling them to investors just like mortgages. These student loan asset-backed securities became a new way for investors to earn money off education debt. It worked until it didn't. When tuition rises faster than wages, something has to break. Between 1980 and today, the average cost of college has increased over 1,200%, while median household income has barely doubled. Students borrowed more, parents co-signed, and lenders, both public and private, kept extending credit. The result was predictable. Millions graduated already buried in debt. Then came 2008. The global financial crisis hit. The housing market collapsed, and with it the illusion of endless credit. But while banks were bailed out, students were not. For millions of graduates entering the job market, there were no jobs waiting. Unemployment soared above 10%. A generation that had been told education guaranteed stability now faced layoffs, unpaid internships, and minimum wage gigs. They deferred payments, defaulted, or simply gave up. By 2012, student debt had surpassed $1 trillion for the first time in U.S. history. The student debt crisis had become a national epidemic, but one nobody wanted to admit existed. Student debt doesn't just affect students, it delays everything: marriage, home ownership, children, entrepreneurship. Studies show that heavily indebted graduates are less likely to start businesses, less likely to buy homes, and more likely to rely on credit cards just to survive. Debt became not just a number but a chain. And unlike other debts, student loans are uniquely unforgiving. Can't discharge bankruptcy. Even death or disability doesn't always erase them. Collectors can garnish wages, seize tax refunds, even take social security payments from retirees. This wasn't just an economic issue anymore, it was generational, a quiet rewriting of the American dream. In the years that followed, Washington tried to respond: income-based repayment plans, loan forgiveness programs, temporary pauses. But the system itself, bloated, privatized, and politically paralyzed, resisted real change. Universities kept raising tuition, lenders kept collecting interest, politicians kept debating. Meanwhile, the debt kept growing over $1.7 trillion by 2024. And the irony? The government earns billions in interest from these loans each year. A system designed to help Americans climb the ladder now profits from keeping them on the first rung. Today we're seeing history repeat itself in new forms. Just as subprime mortgages fueled the 2008 crash, subprime student loans could spark the next one. Defaults are rising, wages aren't keeping up, and new income share agreements where investors fund your education for a slice of your future income echo the same speculative logic that built bubbles before technology promises to disrupt the system. But even AI-driven financial aid can't change the core problem. The price of opportunity has outgrown the opportunity itself. So what do we take away from this? First, education isn't immune to economics. When credit floods the system, prices rise, whether it's housing, stocks, or college tuition. Second, debt is not just financial, it's social. An entire generation's life choices are shaped by the burden of repayment. Third, reform without accountability is illusion. Until institutions, lenders, and governments share responsibility, the cycle will continue. The student debt crisis isn't just a policy problem, it's a moral test of whether a society that once promised opportunity for all can still keep that promise. Education was supposed to free us, not own us. This is not the end of the story, it's just the start of the next lesson. If you found this story insightful, help others learn too. Like, share, and subscribe, because understanding history is the first step to not repeating it.